Something unusual happens when a market falls too far, too fast. The price drops, headlines scream, social feeds fill with panic. And yet, beneath all that noise, the underlying story sometimes hasn't changed at all. That disconnect is where the real intrigue lives. Because every so often, a violent sell-off tells you less about value and more about stress inside the financial plumbing. That's the backdrop to the late January plunge in precious metals, a move so sharp it instantly drew comparisons to historic shakeouts from decades past. Prices didn't drift lower on weakening demand or a surprise surge in mine supply. They fell like an elevator with the cables cut. And when markets behave like that, it's worth asking whether we just witnessed a change in fundamentals or a cascade of forced selling. The timing mattered. A sudden shift in expectations around future US monetary policy hit global markets like a splash of cold water. Investors who had grown comfortable with the idea of easier policy ahead were forced to reconsider the possibility of tighter conditions lasting longer than hoped. The dollar jumped. Bond yields stirred. And in markets where positioning had become crowded on one side of the boat, that was enough to start people scrambling for the exits. Precious metals are especially sensitive to these narrative swings because they sit at the intersection of currency expectations, real interest rates, and investor psychology. When the dollar strengthens quickly, metal prices often feel immediate pressure, but currency moves alone rarely explain extreme one-day collapses. For that, you usually need leverage. Futures markets run on borrowed exposure. Traders don't put up the full value of a contract, they post collateral known as margin. That system works smoothly in calm conditions, but when volatility spikes, exchanges can raise margin requirements to protect the integrity of the market. It's a risk control tool, necessary, mechanical, and historically consistent. The side effect is that it forces traders to either add cash or cut positions, often at the worst possible moment. If prices are already falling, margin hikes can turn a slide into an avalanche. Positions get liquidated not because a trader changed their long-term view, but because they simply can't meet the new collateral demands. Selling begets more selling. Algorithms react to momentum. Liquidity thins out. What started as a repricing becomes a chain reaction. We've seen versions of this before. During past metals manias, exchanges tightened rules into vertical price moves, and the aftermath was brutal. The pattern tends to rhyme: rapid ascent, crowded speculative positioning, rule changes or liquidity shocks, then a violent washout that clears the decks. History doesn't repeat perfectly, but market structure hasn't changed as much as people think. What made this episode stand out wasn't just the speed of the drop, it was what didn't happen afterward. In true fundamental bear markets, rebounds are slow and hesitant. This time, prices stabilized quickly and clawed back a meaningful portion of the losses within days. That kind of snapback often suggests exhaustion of forced sellers rather than a broad, lasting shift in supply-demand dynamics. Mining equities added another layer to the story. Typically, shares of producers exaggerate moves in the underlying metal because their profits are leveraged to price. Yet during the sell-off, many miners fell less dramatically than the metal itself. That relative resilience hinted that equity investors weren't fully buying into the idea of a long-term collapse in bullion prices. Instead, it looked more like they were bracing for turbulence, not a structural downturn. None of this proves coordination or intent. Financial markets are complex systems where incentives, risk controls, and human behavior interact in messy ways. Still, large institutional players with deep balance sheets often have more flexibility during stress events. Publicly available delivery data from futures exchanges sometimes show big banks active during major turning points. That doesn't automatically imply manipulation, but it does remind us that well-capitalized participants can operate very differently from leveraged speculators caught in a squeeze. It's also important to separate paper markets from physical flows. Futures contracts and exchange-traded products can change hands in milliseconds, amplifying short-term volatility. Physical metal, bars, coins, industrial feedstock, moves more slowly through supply chains. When prices whipsaw, but reports from fabricators, refiners, and industrial users show steady demand, it reinforces the idea that financial positioning, not real-world consumption, drove the drama. On the fundamental side, the long-term narrative around silver hasn't revolved solely around investment demand for years. Industrial uses continue to expand, particularly in areas tied to electrification, electronics, and solar technology. Mine supply, meanwhile, tends to respond slowly to price because new projects take years to develop, and many operations are byproducts of other metals. That combination can create periods where demand growth runs ahead of new supply, tightening the market beneath the surface, even as prices swing wildly on screens. Gold's role is slightly different but connected. It behaves partly as a monetary asset, partly as a risk hedge, and partly as a portfolio diversifier. When interest rate expectations shift abruptly, gold often reacts first and asks questions later. But over longer horizons, its path usually depends on deeper forces like real yields, currency confidence, and central bank behavior. Variables that don't transform overnight because of a single news event. So what does an episode like this really tell us? Mostly, it's a reminder that markets are ecosystems of leverage, liquidity, and psychology layered on top of underlying economics. In the short run, structure can overwhelm fundamentals. In the long run, fundamentals tend to reassert themselves, but rarely in a straight line. Sharp shakeouts also serve a quieter function. They reset positioning. Excess optimism gets flushed out. Weak hands exit. Volatility recalibrates risk models. None of that feels pleasant while it's happening, but it's part of how speculative markets periodically cool themselves off without necessarily ending a broader trend. For observers, the key is resisting the urge to draw sweeping conclusions from a single violent move. A crash doesn't automatically mean a bubble has burst forever. A rebound doesn't guarantee smooth sailing ahead. Often, the truth sits somewhere in between, shaped by forces that take months or years to play out. What January's turmoil ultimately highlighted is how quickly confidence can evaporate when leverage meets uncertainty. It showed how exchange mechanics, risk management rules, and automated trading can interact in ways that magnify price swings beyond what fundamentals alone would justify. And it underscored that in modern markets, the path prices take can be just as important as where they eventually settle. For anyone watching from the sidelines, the episode offered a rare, real-time lesson in market structure, a glimpse behind the curtain at how stress travels through the system. The story isn't just about metals, it's about how financial markets function under pressure, how narratives can flip in hours, and how, sometimes, the most dramatic days say more about positioning than about value. And if there's one constant through all of it, it's that volatility doesn't just destroy wealth, it also transfers it, reshapes sentiment, and rewrites short-term assumptions. The fundamentals may evolve slowly, but the journey prices take to reflect them is often anything but calm. If you glanced at the price chart that week, you might have thought the precious metals story was over. A sharp drop, dramatic headlines, red across the screen. The kind of move that makes even seasoned investors feel a knot in their stomach. But sometimes, the most important market events aren't the ones that signal an ending. They're the ones that expose how the system really works under pressure. Because not all crashes are created equal. Some happen when value disappears. Others happen when liquidity does. In late January, metals markets experienced one of those rare air pocket moments where prices fell far faster than the underlying realities seemed to justify. When moves of that magnitude unfold in such a short window, it's usually less about a sudden change in global supply or demand, and more about positioning, leverage, and the mechanics of modern financial markets. The spark appeared to come from a rapid shift in expectations around US monetary policy. Markets had grown comfortable with a narrative that interest rates might ease sooner rather than later. When that outlook was challenged, the reaction was swift. The US dollar strengthened, bond yields adjusted, and assets that tend to benefit from looser policy suddenly faced a colder environment. Gold and silver often sit at the center of these macro crosscurrents. They respond not just to inflation, but to real interest rates, currency trends, and investor psychology. When the dollar rises quickly, metals can fall just as quickly. But currency moves alone rarely explain extreme one-day plunges. For that kind of speed and force, leverage usually plays a starring role. Futures markets allow traders to control large positions with relatively small amounts of capital. That structure adds liquidity and efficiency in normal times, but it also introduces fragility when volatility spikes. Exchanges manage their own risk by adjusting margin requirements. The collateral traders must post to hold positions. When volatility jumps, those requirements often rise. That's where the feedback loop can begin. Higher margin requirements mean traders must either add more capital or reduce exposure. If prices are already falling, many choose, or are forced, to sell. That selling pushes prices lower, triggering more margin pressure, which can lead to still more selling. It becomes less about long-term conviction and more about immediate survival. We've seen this dynamic before across many asset classes. Sharp, cascading sell-offs often reflect the unwinding of crowded, leveraged positions rather than a sudden collapse in real-world demand. The price move looks like a verdict on fundamentals, but in the short term, it can be more of a stress test of the financial structure surrounding the asset. One interesting signal during this episode came from mining equities. Shares of producers typically amplify moves in the underlying metal because their profits are tied to price. Yet while they did decline, the drop in many cases was less severe than the move in futures prices. That relative resilience may suggest equity investors were not fully convinced that a long-term downturn in bullion prices had begun. Instead, the markets seem to be pricing in turbulence rather than a structural break. Another layer involves the difference between paper markets and physical flows. Futures contracts, options, and exchange-traded products can change hands in fractions of a second, magnifying short-term volatility. Physical metal, the bars used in industry, stored in vaults, or held by long-term owners, moves more slowly. When prices swing violently, but reports from industrial users and supply chains show steadier conditions, it can hint that financial positioning, not physical demand, is driving the action. Silver in particular has a dual identity that complicates the picture. It's both a monetary metal and an industrial material. Beyond investment demand, it plays a role in electronics, solar technology, and other applications tied to electrification and digital infrastructure. Those uses don't typically disappear overnight because of a market sell-off. Mine supply, meanwhile, tends to respond slowly to price signals because developing new production takes years and often depends on other metals. That combination can create a situation where long-term supply and demand trends evolve gradually, while short-term prices swing dramatically based on financial flows. When people talk about disconnects between paper and physical markets, they're often pointing to this tension between fast money and slow supply chains. It's also worth remembering that modern commodity markets are deeply financialized. Large institutions, hedge funds, producers, and end users all operate with different time horizons and risk constraints. During periods of stress, participants with stronger balance sheets and less leverage often have more flexibility than those who rely heavily on borrowed exposure. That doesn't require any grand coordination to produce uneven outcomes. It's simply a function of who can withstand volatility and who cannot. What followed the drop was just as telling as the drop itself. Prices stabilized and rebounded more quickly than many expected. In prolonged bear markets driven by deteriorating fundamentals, recoveries tend to be slow and fragile. Faster rebounds can sometimes indicate that forced sellers have largely exited, allowing prices to find a more natural balance between buyers and sellers. None of this guarantees what happens next. Markets rarely move in straight lines, and volatility often clusters. But episodes like this serve as reminders that price is not always the same thing as value, especially over very short periods. They highlight how narratives can shift in hours, how leverage can amplify emotion, and how market structure can temporarily overpower underlying trends. They also expose the psychological side of investing. Rapid gains can encourage confidence, just as rapid losses can trigger fear. When both occur within days, emotions can swing even more wildly than prices. Understanding that dynamic doesn't eliminate risk, but it can help explain why markets sometimes behave in ways that feel disconnected from the real economy. In the bigger picture, the long-term outlook for any commodity depends on a web of factors: technological change, substitution, recycling, new supply, policy decisions, and global growth. Short-term crashes don't erase those forces, just as sharp rallies don't guarantee they'll play out exactly as expected. What they do is remind us that the journey between fundamental shifts and price discovery is often messy. The late January turmoil in metals was a vivid example of how quickly confidence can evaporate when leverage meets uncertainty. It showed how exchange rules, risk management systems, and automated trading can interact in ways that magnify moves beyond what a simple supply-demand model would predict. And it offered a rare, real-time lesson in how modern markets function when stress runs through the system. Whether this episode ultimately proves to be a brief interruption in a broader trend or an early signal of something more complex will only become clear with time. But one thing is certain: the most dramatic days in markets are often less about a single news headline and more about the hidden architecture of leverage, liquidity, and human behavior underneath.